Richard Hemming from Under the Radar Report. It is great to be back. It's great to be back at this time because so much is happening in the markets. And let me tell you, it's at the big end of town. I mean, these represent big opportunities. And the key, as you guessed it, is stock picking. And also at the center of it is, you've probably also guessed, the ubiquitous AI. So let's get to it. Corning this week, one of the pillars of the American economic model. One of the invented electricity about 135 years ago or something, Dow Corning. This company was whacked 20% in the past week. Since 30 June, it's halved. So that's down 50%. This is a company that was bigger than CBA, and now it's half the size. Even now, it's still about 130 billion US. So we're talking about a big company with tentacles reaching all around the world, especially in the world's biggest industrial economy, the US. So what happened? Well, too much growth was baked in to the share price surrounding AI. Too much was baked in, and now there's been a reality check. People are saying, wait, what return are we going to get for all these costs? So we're seeing this happen across the board. The NASDAQ 100 is down 10% since its early June highs. So that's a big deal. We're seeing Tesla about a third in the past few months. It's not just these AI stocks, it's also growth stocks in general. When they come off the growth, when people don't see growth anymore, they hit the reverse button. Look at CSL. Basically, so much value in these growth stocks is baked in the terminal value in DCF valuations, that when interest rates go up or don't look like they're coming down, there's a lot more pressure on them. And we're seeing that pressure manifest in the share market. The major point is valuation matters. It does, especially with rising interest rates. So you cannot rely on ETFs. You cannot rely on blue chip dividends alone. You need the growth that small companies growing into big companies can give you. You need to be buying stocks that are cheap. You need to be buying stocks that have potential, but that it's not priced in. That's the key, priced in. So look, what we're looking for at Under the Radar Report are strong swimmers. I love swimming, and I'm interested in strong swimmers. And whether or not they're strong swimmers is not dependent upon AI. In the past, we've picked Southern Cross Electrical, we've picked Superloop, the network roller. So we've produced these stocks and they've really gone well, but they've benefited from AI. And guess what? We've taken profits, because that's what you do. You take profits on those big stocks and you reinvest where it's not priced in. And we go into detail in a recent report on AI and the effect of AI, because there are some opportunities and we're seeing value in the software space. And look, if you take two words out of this, two words, mission critical. So basically, big water producers, big energy producers, gentailers, retailers, energy retailers, they're not going to want to rely just on algorithms. We've seen how much hacking is out there. We saw what happened with OpenAI. We saw what happened with Origin. They want humans to be accountable. And that's why mission critical is so important. That's why, a couple of the stocks we look at service those big utilities in software billing, Gentrack and Hansen. We like Hansen. Too early for Gentrack, but have a look at these stocks. Catapult, well, it's not mission critical sports. They do wearable devices. They do interpretive analysis for teams. But, world sports teams are hardly going to be insourcing all this stuff. They're going to need experts in the field like Catapult. So there's opportunities out there in the software space. But look, these are high-risk stocks. I don't deny it. That's why we balance them out with small-cap dividend payers, and it's a reason why so many of or pretty much all of our dividend portfolios deliver outperformance over time. It's great to be talking to you. I'll talk to you next week, but stay tuned because this is an evolving space.